Imagine being in a very nice trade, but suddenly the market turns around and you get completely wrecked and liquidated. In this quick video, we will be talking about how to not get liquidated even when using high leverage while trading cryptocurrencies. I will show you exactly what to do so you will have literally zero chance of getting your trading account instantly destroyed. Majority of people want to increase their profits, so they borrow money from an exchange. That can easily be done with leverage, but there comes a problem. Because crypto is very volatile, it makes it a prime target for liquidations. Liquidation occurs when an investor cannot meet the margin requirement for their leveraged position, and unfortunately that happens every day very often. Traders do not know how to use leverage properly in their advantage while trading Bitcoin, Ethereum and other crypto, and that most probably happens because they do not understand what leverage even is. While borrowing funds to increase trade position size can multiply our gains, it's a highly risky move because on the other hand, it can also massively increase our losses if the market moves against our leverage position. And with high leverage, there comes something called a liquidation price. At this price, our entire position will be forced to get closed and we will lose the entire margin of the position, or even worse, we can lose the entire account balance. That happens because there are insufficient funds or margin in the position to keep the trade open, so the exchange is forced to close down the trade to cover our loss. Let me give you a quick example. On Bitget exchange, there is an option to use up to 125x leverage. Of course, using such a high leverage is super risky and definitely not recommended. So let's say we will use 10x leverage for a simple long position. What it really means is that the margin to open the trade is going to be 10 times less than the actual position size. But now, if the market moves for only 10% in the wrong direction of our trade, we will get liquidated. Why? Because 10x leverage times 10% is 100%, aka our liquidation price. So what leverage basically does is that enables the use of a bigger position size with less capital. Now let me shock you a little bit. It does not matter how high of a leverage you use. Let me explain. On Bitget exchange, there is a calculator available for you. By the way, sign up on Bitget after watching this video with the link in the description, because they are giving you right now more than $4,000 free trading bonus, so you can start trading literally for free. If we now go under futures with USDT and futures, there is in the upper right corner a futures calculator available. So let's say we want to enter a long position on Bitcoin. Let's go with 10x leverage, open price at $20,000, close price 21,000, current rate 20,500, and the amount of Bitcoin, let's simply go with 1. The only thing that really matters when it comes to trading is how much profit we make on a trade. With this specific trade, we would make a profit of 0.0487 Bitcoin. The ROE number, or return on equity, is showing almost 50% gain. This value is calculated based on the margin. Now let's increase the leverage a little bit. Let's go with 100x leverage actually. So you can once again see the profit is 0.0487 Bitcoin. So it literally stayed the same, but the ROE number is much higher at almost 500% gain. But remember, the ROE number is calculated based on the margin. And with using 100x leverage, the margin went 10x lower in a comparison when we used 10x leverage. But margin is not the only thing that actually changed. Let's now open two long positions on Bitcoin using different leverage. First, let me open a trade with USDT using 10x leverage and a margin of $10 buy long. You can see here that the position size is 0.005 Bitcoin and the margin is almost $10. Now pay close attention to the liquidation price. With this trade, the liquidation price is $17,105. Let's open the exact same trade with USDC, but this time we will use 100x leverage. Let's set the margin to 10 USDC so it will be the same as the first trade, and click on buy long. The position size is now almost 0.05 Bitcoin, which is 10 times more than with 10x leverage. Of course, because the leverage we used with this second trade is 10 times higher. The margin stayed the same, $10, but the most important thing, the liquidation price is now much closer to our entry price. In the first example, Bitcoin price needs to move for 10% in the wrong direction for our trade to get liquidated. However, in the second example, Bitcoin price needs to move for only 1% in the wrong direction for us to get wrecked and liquidated. But with both trades, we would lose the exact same amount, which is $10, because that was our margin, or we can also say our money that we used for the trade. The rest of the position size was borrowed from the exchange with leverage. In the left here, you can see exactly how big of a portion position is our margin in the position. But please note, the margin is the amount you lose if you get liquidated using isolated margin. That is very important because Bitget exchange offers two types of margin, isolated and cross. In simple words, isolated margin isolates our margin in a position, so if we get liquidated, the only thing we lose is this margin in a position. However, using a cross margin is, in my opinion, more advanced and definitely not recommended, especially if you're a beginner. In a case of a losing trade, cross margin will drain your entire account balance to protect your position. So if you don't set a stop loss order with a trade that uses cross margin and the market goes against your position, your entire trading account will be wiped out if the trade reaches your liquidation price. That's why sometimes you can see people posting their trading results with over 100% loss. So the first thing that you need to do to avoid liquidation is to use lower leverage or no leverage at all. Now, you're maybe thinking to yourself, bro, I already know that I use too high of a leverage, but what most people do not know is how position size works. Once again, leverage does not matter. What it really matters is your position size. Position is calculated leverage times margin. So if we use 10x leverage with $10 as a margin, our position size is $100 or 100 contracts when we trade futures. Now, we can also get a position size of $100 on a different way. We can use 100x leverage and $1 as our margin. Position size with both examples is the same, and that is what really matters. But here comes a catch. In the first example, we borrowed from the exchange 10 times the amount of margin, and in the second example, we borrowed 100 times the amount of margin. Because we borrowed more in the second example, or we can also say because we used a higher leverage, the liquidation price is much closer to our entry. That's why for most trades, using such a high leverage does not really make sense. Usually, we want to use leverage that is below 10x. That way, the market needs to move for 10% for us to get liquidated. Maybe you're now thinking, bro, I don't want to hold the trade for that long. I want to get out of the trade earlier. And this is exactly where most people get it completely wrong. Majority of beginner traders rely on a liquidation price, which is very dangerous because usually they also do not know how to properly calculate the position size. They use high leverage and the position size goes through the roof and gets insanely high. That's why you should now pay close attention. Only 10% of trading success is our trading strategy. The most important thing is risk management and trading psychology. Beginner traders often look for a perfect trading strategy with very high win rate, but with my 5 years of experience in crypto trading, I can guarantee you that 100% win rate strategy does not exist over a long run. We as cryptocurrency traders should primarily focus on risk management. The most important thing in risk management is a position size and stop loss placement. Maybe you can now already see where I'm going with this. Personally, I never rely on a liquidation price, and in my opinion, you should not either. Instead, what we should do is to rely on a stop loss order. On Bitget, when you enter a trade, it's super simple to set a stop loss. That's why the link to sign up on Bitget is in the description. When you enter a trade, on the right side, there is a button where it says stop loss. You can set a price where you want to close down the trade, or we can also say where we want to get stopped out of the trade. Usually, we want to set the amount to 100% and click on confirm. Another thing that new and beginner traders get wrong is the position size calculation. Position size is dependent on the stop loss placement, and now you can clearly see that if majority of traders do not use a stop loss and rely on a liquidation price, position size is often wrongly calculated. Let's say we want to enter a new short position on Bitcoin. I always recommend to first visualize it before doing any calculations around it. On the left side of Bitget exchange, there is a tool for long and short positions. Let's go with a short position. Now let's say we want to enter a short at $22,000. We will set a stop loss at 1.27% and the risk at 2-to-1 risk to reward ratio. Remember, when trading, we always want to target at least 2-to-1 risk to reward ratio. That means that the reward will be 2 times bigger than the loss. Also, there is a common misconception about how much you should risk per trade. Generally speaking, we should risk between 1 to 3% of our entire trading portfolio. However, that does not mean to set a stop loss at 1 or 2 or 3%. That simply means when we lose a trade, we will lose 1 or 2 or 3% of our trading portfolio. So if we go back on our example, we set a stop loss at 1.27%, and let's say that our entire trading portfolio is $1,000. Let's also say that we are a beginner trader, and that's why we will risk 1% of our trading portfolio per trade. That way, if we lose a trade, we will lose $10. To properly calculate our position size, we can use a very simple formula. If our stop loss gets hit, we want to lose $10, which is 1% of our trading account. So to calculate our position size, we can divide those $10 by the percentage number of our stop loss. The calculation would be $10 divided by 1.27%, and the result is $787. This is our position size. Now, to enter a trade on Bitget using USDT and futures, we can switch from quantity unit to cost value. That way, we can use the amount of USDT instead of converting this value to Bitcoin amount. But remember what we said before. We can use leverage to borrow money to get to this position size. If we use 1x leverage, our margin needs to be $787, but if we, for example, use 10x leverage, our margin will be 10 times less. So in this case, $78.7. And this is the correct position size to be used with the $1,000 trading account, 1% risk per trade, and 1.27% stop loss placement. The only thing that really matters when using leverage is that the liquidation price is not hit before our stop loss. Generally speaking, leverage that is below 10x is, in my opinion, good to use, but of course, in that case, our stop loss needs to be placed before the market moves for 10% in the wrong direction of our trade. Otherwise, liquidation will trigger first before our stop loss. Before we talk about a big misconception in trading cryptocurrencies, smash up the like button as hard as you can, because the goal for this video is not to reach 900 likes, but to pump the likes straight to 1000. Thank you very much if you right now actually smashed the like button. One big misconception I see a lot of people believe in is that changing leverage once you are already in a trade affects the profit and loss. That is simply not true. Let's enter another trade, this time a short position on Bitcoin with USDT and futures on Bitget exchange. Let's use 25x leverage and margin of $10 and click on sell short. On the left here, it says that the position size is 0.01 Bitcoin, or a little over $200, and the margin is $9. If we now click on this pen button and go with decrease margin, we can see that we cannot decrease it because the number here says 0.000. However, let's now change the leverage by clicking adjust lever and increase it to, let's say, 50x and click confirm. If we now once again click the pen button and go with decrease margin, you can see that suddenly we can decrease the margin of the trade. But even if we now decrease the margin of the trade, the position size is going to stay the same. And as we mentioned before, what it really matters is a position size, because the profit and loss are based purely on the position size. So changing leverage mid-trade only allows you to adjust the margin of a trade, but it does not affect the profit and loss. But there is one very good thing about leverage. If we have, let's say, a crypto trading portfolio of $1,000, we don't have to have all this money sitting on an exchange for trading. We can only have a portion of this portfolio on an exchange, and with the use of leverage still trade as we would have $1,000 on the exchange. For example, on Bitget exchange, we may transfer only $500, and with the use of 10x leverage, we can go as high as $5,000 for the position size. Of course, in this exact scenario, with the risk of 1% of entire trading account, we should have a stop loss set at 0.2%. That way, in a case of a losing trade, we would only lose $10, which is 1% of our $1,000. But using Bitget exchange is pretty safe, because in a case of a hack or some kind of a breach, they have an emergency insurance reserve of $200 million. Another pro tip I have for you: do not add to a losing position, cut losses early, and make sure winning trades are bigger than losing trades. With it, I can guarantee you will be one step further to become a profitable and a successful crypto trader. So to avoid liquidation and not get liquidated with crypto leverage trading, use lower leverage. Below 10x is what I personally recommend you. That way, liquidation price will be far away from our trade entry, and we can simply use a stop loss order to exit our trade if it goes in the opposite direction. If you're just starting out,